Have you noticed something unusual about modern markets? Bad geopolitical news breaks, markets fall briefly. Then they roar back. Weak economic data prints, stocks dip. Then buyers step in. There are no sustained downdrafts. No prolonged fear cycles. Just relentless dip buying. Why? The answer begins in 2008. Since the global financial crisis, central banks have intervened repeatedly to stabilize markets. Emergency liquidity, quantitative easing, rate cuts, backstops. Over time, investors internalize the belief nothing systemic will be allowed to fail. And if something does break, the central bank will step in. This conditioning changed behavior. Instead of fearing downside, investors now anticipate rescue. Every decline becomes an opportunity, not a warning. Markets have been trained to believe in a safety net, but safety nets distort risk perception. When participants believe losses will be cushioned, they take greater risks. Valuations stretch, leverage builds. Speculation increases, dip buying becomes automatic. It is no longer analysis. It is reflex. There is another structural shift reinforcing this pattern: the rise of individual investors. Zero commission trading, instant access, social media-driven conviction. Retail participation has surged over the last decade. Many new investors entered the market during periods of aggressive monetary support. They have experienced volatility, but not prolonged bear markets without intervention. Their reference point is simple: dips are temporary. Buy them. This combination, central bank backstops and reflexive retail buying, creates markets that resist natural corrections. But here's the danger. Healthy markets need sustained down cycles. They need price discovery. They need excesses to unwind fully. If every dip is immediately reversed, risk never properly clears. Imbalances accumulate beneath the surface. And when markets eventually encounter a shock that policy cannot immediately absorb, the adjustment can be more violent than expected. The belief that nothing can go wrong is itself a risk. Markets are healthiest when fear and optimism coexist. Right now, optimism dominates reflexively. That does not mean a crash is imminent, but it does mean complacency is elevated. And complacency is rarely rewarded long-term. If you value disciplined, strategic market analysis without hype, subscribe to Market Signals and stay ahead of the cycle.